Welcome to our Halloween special, my friend.
Hang on, hang on.
Holy fucking shit, it's a dinosaur! Jesus Christ, what the fuck?
Welcome, ladies and gentlemen, to our special Halloween Grey Market talk on the Tactical Brief with former market maker, Thunder God, and apparently dress-up specialist Thorsten Wegener, and market maker extraordinaire, bond trader, chief investment officer for hundreds, millions, and billions, big money we're talking about today, Nic Themistocles. Nic, thank you for being my guest.
You're welcome. Good morning.
Do you like my outfit?
Yeah, I'm not sure whether you look better or Chris Hemsworth in this thing, but I'll do the comparison later.
Well, I'm sporting it now for 2 years in a row because somebody said, yeah, you used to be good looking when you were younger and slimmer. Now you're a bit like Fat Thor. And I thought, yeah, Fat Thor, that's the one I'm going for. The only thing which is a bit disturbing is the glasses, but I'll put them on now in a minute anyway. Oh, before we start, Nic, we had one shameless plug arranged about me asking now what I'm going to do in January.
Yes. What are you going to do in January on the 19th, 20th, and 21st?
Oh, that's a very specific question, Nic. Thank you for asking. We will be holding our first seminar, Option and Macro Bootcamp. And I can just recommend everybody, please watch the little video, which I will put here in the description as a little spoof video. Nic participated in it as well, like my other colleagues. Thank you for that. We will talk about getting a framework, what to do in a macro environment, how to judge it, and how to put on option speculation trades and hedges. And that's pretty much all of it. Very well, comprehensive description in the 20-minute video. Have a look at it. If you want to join, I would be very happy to see you. Thank you for the plug, Nic. Let's start with the show. So, and I shall do that because otherwise I cannot see my screen. Share screen. Let's get the presentation up. You see it, Nic?
Absolutely.
Good. Our Halloween Grey Market talk. What are we having today? Oh, by the way, that's the full outfit. If people didn't notice that, I was actually Fat Thor. The last year, actually, I grew my beard a little bit longer to make it more believable. That's where the picture's from. So what are we having today? Thoughts from scary Germany. Then the Deamon is selling his JP Morgan shares. And then we have a couple of scary charts. So take this today with a leisurely smile, what we're doing today, because the motto is scary shit we're going to show you on the screen. Thoughts from scary Germany is obviously let's let it blow up. Let's blow it all up. You see, I'm losing actually my conscience when I talk about Germany. We mentioned her in the last show, Sarah Wagenknecht. The communist, self-proclaimed socialist, whatever you want to call her, hardcore style. And she's setting up a new party to actually, collect voters on the right side of Germany, where a lot of people who are not happy with the government policy at the moment are voting for the AfD, Alternative for Deutschland. And she realized that the protest vote could actually, feed her quite nicely. Unfortunately, the first opinion polls said people in Germany, 10%, would vote for this communist in Germany, actually, if there would be elections held next Sunday. Quite a scary perspective in which direction Germany is going, which leads me over to a nice next point. This is where Germany is going at the moment. I have two charts on here. One is industrial production in Germany split into energy intensive and not energy intensive. If you want to break it down a little bit facetiously, the orange line, which goes sideways, not growing, going sideways, is pretty much delivering pizzas. Not very energy intensive, but it's everything in, you don't have to put up a heating or use energy to produce anything interesting. And the blue line going down since, a straight line since 2021 is everything which requires energy as an input factor and the associated costs. And on the right, you see the breakdown actually. Where we are losing market share worldwide in paper, in mining, and petrol, refinery, the whole chemistry business, glass and metal production, steel. everything which requires huge input in energy costs. Germany has the highest electricity prices now worldwide, and the discussion going on is, are we destroying our industrial base? And we could say, no, we are not destroying our industrial base because we have Siemens. Siemens will come to the rescue. And last week, one of the most, well, bizarre news flashes that came out was actually Siemens Energy. And I went to Siemens Energy's website. They are the world leading producer in windmills, in the real new energy environment, which would bring us all Shangri-La, the golden land, the ever-growing industrial production, and that's their website. Welcome at Siemens Energy, a world-leading company in energy technology. And that actually what came out this week. Siemens Energy sucks the big one. The shares lost 40%, and they need around 15 billion in state guarantees, they say. And our Chancellor, Mr. Scholz, already commented on this. Yeah, there are conversations with Siemens Energy what can be done, which is very interesting. Yeah? This is the poster child for the new economy we have allegedly on the shift from being an old-fashioned country which is using fossil fuels and Russian gas to this new economy where the saying in Germany amongst the politicians has always been, well, the sun and wind are not sending you a bill. Yeah, that's true, but you will, guys, and your bill will be far higher than what anybody else could sell. And the company Siemens Energy was a spin-off of Siemens because they obviously smelled the rat already in 2020 and said, yeah, we put that into in a single independent company, and we hold 25% of it. So if you would have invested in the green dream of everything being windmills in Europe from Spain till Norway, you would have destroyed, if your timing was a little bit bad, 81% of your capital. Yeah, it tends to get big hits, and it's running out of money. It's not running out of orders, interestingly enough. They have about 100 billion in orders as a backlog, which at this time I would say is actually a huge burden, because with every dollar in turnover you make, if you start losing money, well, the more orders you have in backlog, the more money you will lose in the future, for sure. And Siemens still has 25% of this thing in its books. So the conversation is, wait a second, why should the German taxpayer cough up 15 million in guarantees to keep Siemens Energy alive if Siemens, which is not a poor company, you could do it yourself? Why did I put this chart on? It's a logarithmic chart, and it shows beautifully how we go from the bottom left to the top right, steady growth rate. What you don't want to see, a chart like this breaking one day. Yeah, and that is where we actually are positioning ourselves in Europe at the moment with this absolute madness we seem to perpetuating here. And if the poster child actually goes down in its knees because they can't benefit from the wind energy, which is highly subsidized with energy costs, with production facilities, you name it. Why should there be anything? Why should there be anything beneficial to this industry at all? Nic, you're a foreigner in Germany. Yeah. Oh, well, yeah, I think it's time to actually brag about that. Yeah, because hey, when I grew up, Germany was the country where the trains ran in time, where we had
absolutely
the best engineers in the world. Where you went to university, you knew you would get a good paying job and everything was fine. Not anymore.
That's true. That's absolutely right. And I, it just goes to show you there are a number of things here. I mean, what are the problems? There's a problem of government. There's a problem of governance within the government. They're very slow at with bureaucracy when they don't need to be slow, and when they do need to be slow, fast. They are very fast, but they do make a lot of mistakes. And there's still a big question mark. With all of this COVID and vaccine and all of that stuff. But here's a classic example of underestimating the cost of transition and the feasibility of the timing of the transition that is wanted within the government. I mean, it is their goal, but they have totally underestimated, what this thing is going to cost in terms of money, in terms of time, And, this is a classic example of, they underestimated or they overestimated how fast they could get to this net zero. So Siemens Energy come out and say, well, we've got a great idea how to get even more power from these windmills. So let's make the blades a little bit bigger. And suddenly this causes a great deal of problems. And I have to say, it's a shame, but it is something that should be a wake-up call, and it shouldn't simply be a case where the government say, okay, don't worry about it, we'll fix the 15 billion, that's not really a lot of money, and we'll just carry on regardless, because these are small little time bombs that are clearly there with their plans for this net zero. And I think the whole net zero target needs to be reviewed, as has been reviewed by Rishi, as has been reviewed and adjusted by the Swedes, I believe, have said themselves, and will be reviewed by many other countries as well.
Let me ask you this question. You just mentioned that the 15 billion for Siemens Energy is not a big deal. I remember, is it 2 years back now, when the UK was not allowed to save British steel, and we were talking about 20 million, not billion, 20 million in some bridge loan over there because of European Union. You were still under the purview of the European Union laws at the time, and you were not allowed to chip in 20 million as the state, so some Indian company took it over. What's that all about? How does that, the question I want to ask you as the foreigner looking inside, is that purely a political problem we have here, or is it coming all together?
And this is where we're coming to ultimately, is the fact that the government are trying to control much more what is going on in the economy. They already began this thing with the COVID time. People rely on incomes from the government. Companies are now the first place they go to. They don't go to their parent company, Siemens. The first place they go to is the government and say, you've got the printing press, give us some. And I'm sure they will. And I'm sure nobody in the EU or anywhere else is going to bat an eyelid on this thing. Nobody's going to say anything. And it almost certainly will go through. The shares will, like they did with Uniper, that will go down to next to nothing, and shareholders will be hit. And they believed in a dream, and they got delivered a nightmare, I'm afraid.
So if you're an investor on the outside, which you are, where would you in Europe at the moment invest money, if at all, in Europe, Nic?
Well, I mean, this is a particular story. So somebody who's invested in Siemens Energy has bought into the idea of transition and bought into the idea that there is value in this transition. And it may well be that there is still a lot of value to be held for this transition. But it's probably going into these smaller companies who are trying to invent or create the fireproof battery or things like this, which could add value and which would be reasonable targets. But these massive companies, you can see that they're just cocking it up.
Oh, by the way, John Lewis just stopped or interrupted selling insurance policies for electric vehicles. Because they have to increase the premiums massively. So electric vehicles will have now far higher insurance premiums, because if something goes wrong with this car, it immediately blow up. I'm exaggerating here. The real point is, I remember how they sold it to us. Oh yeah, an electric vehicle will be awesome because it has less moving parts. It's just a battery and some electric engine.
It's a quick lawnmower.
It's cool, it's cheap, and you can charge it for no money at all, and
Absolutely.
it's low. And now all these things come tumbling down. If I fill up my diesel, it's cheaper than I would charge my Tesla.
So look at the damage that was created at Luton Airport. There was a car park, full of cars. Someone's charging his electric. If I understood what happened at Luton Airport, 1,500 cars got burnt. Because of some problem, and almost certainly that's a fire thing with a battery. I mean, it may not be, and I'm saying something false, but most likely this is a battery problem. All of this is not counted when people say that battery operated vehicles are the solution for the future. You think all these German companies that were so fantastic when they, created their combustion engine, and they've given it all away with a commitment to say, okay, we're going full electric. We're going to chase Elon Musk. And instead of coming up with something alternative, they've given this advantage away. And I have to say, that's a real shame. And as a foreigner, I say that's a real shame to see such a great engineering know-how country just basically give it all up and create lawnmowers. I mean, it's outrageous.
I find it interesting how fast time has changed. You might remember that because you're a regular guest in my virtual trading floors. Was it 3 years ago when Tesla came, or Elon Musk came out actually with a Cybertruck? I made a fucking killing in Tesla shares because I looked at this car, said it looks like the Batmobile. My neighbors will still hate me, even though I'm driving now an electric vehicle. I have to have one. Yeah. So we built up a nice position in call options, made an absolute killing. I got out at 100% profit plus, then I made another 800% before this big but at the end of the day, the Tesla shareholders who wanted to sell them at the time paid for my Tesla Cybertruck, which I ordered. I'm not taking it if it ever gets delivered out now. I'm beyond that. Why on earth would I take an electric vehicle which has literally no resale value anymore? That's also the point that's dropping. High insurance premiums. Somebody can switch it off at the source if they say, oh, we'll have a driver-free Sunday. It's all looking very, very scary here with this idea being pushed down our throats, especially when we see, it has even further implications for me. If Germany fails, Nick, the European Union fails. And the European Union was a pretty cool thing. Yeah? What's not to like? Free travel, no fees. You could work in every country you wanted to, but it needs a strong paymaster general. If the paymaster general goes bankrupt, this whole idea which produced peace for generations is out of the window. Why? Because some morons want to shove down an idea down our throat, which actually is not effective. We had this conversation before. If you want to reduce CO2 emissions, which seems to be an evidence that, yes, it has an effect on climate, then you want to reduce CO2 emissions. You do that by putting up all interesting energy mixes you can get. You don't switch coal on again because you don't like nuclear. It's madness.
Yeah, and in this respect as well, where Germany is very dependent on China, I mean, it's not just their foreign policy that puts them at a disadvantage with someone like China, and they do export, or they used to export, an awful lot of their engineering know-how to China. But there was an interview with a former member of my team in my old shop, Yanjing Gast, and she talks about when you're in China and you go out there, you don't see German cars anymore. The Chinese are already ahead of the curve with electric cars. So don't go out there. This German sort of experience of we know how to make cars and stuff like this. They missed the electric opportunity. Elon got that. Chinese are able to deliver in size, and then Volkswagen come up there and say, hey, guess what? We've got more of that, where that came from. And the Chinese say, yeah, but we've got it as well. What do you offer that's different? And in the old days, you'd say, oh, precision engineering. It's a lawnmower. There's not much precision in this thing. So what have you got?
They beat us up in pretty much every field. I remember that fondly. 12 years ago, the last time I was in Hong Kong. I stayed in the peninsula where you stay, obviously, yeah. And I went down for breakfast, and there was a big, board outside. It said, today, Logan bread. And I thought, ooh, what's Logan bread? That sounds very interesting. What they meant was actually Laugenbrot, yeah, which is a very German way of making bread, but they misspelled it, called it Logan bread. So I ordered Logan bread with my ex. Nick, you couldn't make it that good in Germany, in Bavaria, Munich, or someplace else. So I asked, is your baker a German by any chance? No, but he did an apprenticeship with a German baker. And I thought, yeah, that's it. There you see it. Well, it's fascinating. I think this topic we could rail on for at least
we could do a whole session on sort of China and energy and transition, but it's a good place to pause. It's
Absolutely.
disappointing.
I think we should move on to the next scary bit I found this week, staying with the motto of our show today. Jimmy Deamon selling JP Morgan shares. That made quite a bit of headlines. And I wrote underneath it, nothing to see here, move along. That was the headline on CNBC. Big conversation, obviously. Deamon is selling his or parts of his stock, 9% of his holdings, which amounts to 140 million. He worked for 20 years, correct me if I'm wrong, Nick, at JP Morgan, and so far he has never sold shares. So to be purely objective, yes, he's a little bit older and he's probably planning for retirement, and why should you have all your eggs in one basket? Once you decide, you might call it a day and retire and play a little bit more golf to meet you on the greens eventually out there.
Or to finance his political campaign, yeah?
Still a good point, yeah? I remember that a year before the last election, he always popped up in the news. Oh, Mr. Deamon.
You never know.
Yeah, and he never really denied it. That was the interesting part. He never said, no, over my dead body. It was always the wiggly answer. So, yeah, he has a reputation. Unfortunately, he's a greedy banker, so I don't think that will go down well with the people of the United States. Yeah, there are a lot of things shifting at the moment, and hey, even I wouldn't vote for a banker nowadays. Why do I have the headline Sir John Templeton there? It reminded me, as I'm old, of the bull market we had in the 2000s, internet bubble. Yeah, everything changed. A new paradigm was out there, and Sir John Templeton, at the time already retired in wealth and billionaire fortune on the Bahamas, he sold pretty much the whole internet bubble at the peak. And I saw an interview with him a year later. What made his timing so unbelievable? Let me a second, I still have to get this cough out. And he came back and said it was actually very easy. We had all these new millionaires, centimillionaires in the market. And what they did, they were locked in. They weren't allowed to sell their shares. So I said to my team, take a big calendar out and just put in, when is their holding period over? When are they allowed to sell their shares to stay millionaires and billionaires? And that's when we started shorting the market, because one thing always stays the same: greed of individuals, personal greed. If you have wealth, you want to keep it. You don't want to piss it away. And what the news said is actually that Mr. Deamon's sales will come into effect in January. Yeah, that made me think. I remembered what Sir John Templeton said. Said, okay, fine. Maybe we don't see, even though the market took, or JP Morgan shares took a whack this week of 3% after the news came out, but that in the greater scheme of things is nothing. Yeah, that could be normal, a bit higher than one standard deviation. Random move. So as Mr. Deamon doesn't want to sell 30% lower, I would assume that we see a stable market for JP Morgan till the end of the year before that starts getting into effect. And if it's Jimmy selling his shares, there will be others there as well who want to get out. People who were invested in his leadership, with that he was the right man at the right time in the right place to run this company. And so it's clearly something I want to have an eye on. And especially if you look at the long-term chart, it's a logarithmic chart of JP Morgan. It's again, where are we? Yeah, okay, ooh, wow, we made a 52-week low now in quite recently or something in JP Morgan. Look at this chart and tell me that the man's timing isn't impeccable. If he worked 20 years for the firm, and he's selling at this level and cashing out on his position, it's like the Siemens chart. You don't want to see something long-term like this breaking eventually, because that will have implications on the whole economy. Before we started, press the record button, Nick, you mentioned Citi as an alternative to it.
Or it was Bank of America, actually.
Bank of America.
The point being that, you know, did Jamie Dimon really do such a fantastic job to be worth $1.5 billion? And you know, you can argue, was he just at the right place at the right time? And you know, if you look at charts like this, you know that the US stock market has been beefed up with money that's come from the Fed. So there's been a lot of printing. It's market beta. What has he done in terms of alpha? What has he delivered over and above other companies? And if you look at, comparable, decently sized other companies, City of Bank of America, Bank of America are in nowhere near as good a shape as JP Morgan. Therefore, I would say there is value to, whether he's worth $1.5 billion, what is the right number? Hey, why not $1.5 billion? But he's certainly done a good job at JP Morgan. I think very few people would, if they look at, what he's done for the company, employees, shareholders, stakeholders in JP Morgan would all say that he's done an outstanding job, and other banks could have done have done a really bad job at the same time. And so for that reason, I'm less sort of stressed that he's a billionaire. And I'd say great opportunity. Wouldn't we all want that?
Well, he might have been worth his 1.5 billion if he hadn't done the one mistake he surely did during his career in 2009, firing me after they took over Bear Stearns. That was clearly.
It's okay. I'm also former JP Morgan, so
Yeah, but you left, I think.
At 1995, where was the stop there? That looks like an important low. I think the market was waiting for me to go, and then it sort of off and rallied.
Oh well. No, bless him. Bless him and bless his 1.5 billion. It's just, it's one of these things to make a lot of money and being rewarded for what you do. And if you are the founder and you are the guy who created that company, fine, absolutely on you.
I understand exactly what you're saying. And, did he invent something? And as I say, there's a lot of this 1.5 billion is beta, and beta meaning, look, the market has gone up. How did the market go up? The market went up because the central banks of the Western world printed a lot of money, and therefore they created a very, very big financial asset bubble, which has yet to burst and it looks like can't afford to be burst, at least for the next years and years to come. If it is, then America is in trouble.
Yeah, right time, right place, good management.
Right time, right place, and there you go. I think that's what we all want in our career, is being in the right time, right place.
Yeah, absolutely. I remember somebody who became a multi-millionaire, and I met an older gentleman at the time. Said, "How did you make your money?" He was working for IBM, and he said, "I sold typewriters." I said, "What, you became a rich man by selling typewriters?" And he said, "Yes, this ball head typewriter that was new, and I was the salesman. And my customers like German Mannesmann, who then ordered 10,000 of the typewriters, who in today's money would have been each $25,000 a piece."
Wow.
I said, time is moving on, but right time, right place. So S&P, another October full of joy. And I will get into this chart in a second. So we have a correction now of 10% from the July peaks. And by all technical indicators, the big ones, we've crashed through the 200 day moving average. We mentioned that last week in the show, that it didn't look too nice. And Jim Bianco from Bianco Research actually summed that up beautifully. I stumbled across that on LinkedIn, and he said the S&P 500 has now corrected 10% from its July 31st peak. This is the first such correction since the market bottom October 12th, 22. I'm surprised I see no screaming red headlines about this. It tells me it is not viewed as a big deal. Then the decline will continue until it becomes a big deal. And I thought, yeah, that was absolutely it. Did you hear anybody actually showing any concern about the equity markets at this point in time, Nic?
No, I agree. Jim Bianco is very good with his words, I must say, and he's very provocative with his words. No, I mean, this is, suddenly you see all of the recession guys who were predicting the recession last October, who have sort of been more vociferous, throwing more of these end of the world charts out on Twitter. But generally, I think people are fairly sanguine. And then if you remember from last week, 4,100. Since my own charts have had this thing as a wave 4 in August, and looking for a correction down between 4.2 and 4.3, I said, with a drop dead point on 4,100. If you look at the low on Friday, it was actually quite exciting to watch. I think the low was something like 4,103, and then we bounced up. We may well bounce up again. We'll see if we go through the 4,100. If it does go through the 4,100, becomes, well, now it's a different type of correction to the one that I anticipated, and therefore I've been fairly sanguine about this thing the whole time. Expecting down to 4.2, 4.3, and it's slipped a little bit through. We'll see what happens if it holds. If it doesn't hold, we'll have to redraw the numbers.
Yeah, well, we mustn't be worried at all anyway, because as long as we have investment bank and analysts who are telling us where interest rates are going, then we are saved, saved by the market professionals. What I have in front of me here is a chart. Somebody went through the effort and actually mapped what the investment bank said, where the Fed funds rate would be in the future, and then what it really did. And I said to Nic earlier, well, this completely shows how completely useless analysts are. If you are looking at this chart, it's actually not what I really believe. I think there are extremely clever guys in there who can get into details of companies and deliver you data points. When we're talking about the big economy forecasting the Fed, Nic, would you agree that this is absolutely useless?
Yes. I mean, as I said, the investment banking analysts are really good at analyzing, but I've been in this game for 40 years. These guys are absolutely useless at forecasting. Analyze one thing, forecasting is something totally different. And all of these lines that you see, they're always, or majority of the time, wrong, and therefore you should ignore forecasts. It's very difficult to forecast, and you should sort of be very careful about forecasting.
Nic, I was actually trying to set you up for the conversation we had before we put the record button into action, because what I said to Nic, they're completely useless. And Nic said, no, I totally disagree with you. You just do the opposite of what they forecast. So you gave me the trader's answer in there. And that is what we see here. So if we look at the right end of the chart at the moment, everybody assumes that, yes, the Fed is going to lower interest rates soon, right? And then in 25, 26, they're going to pick up again. So taking this chart as a whole into consideration, one is inclined to say, so that is probably not what's going to happen at all.
Well, what they're forecasting is actually they've fallen. So if you remember, we've all been doing it. I'm as guilty as others, saying, fight the Fed. They don't know what they're doing. There's no way that they can reach rates of 5%. They'll probably pause somewhere between around 3.5, I think I was looking at. And they've gone way beyond that. So the whole market was also in that fight the Fed mode, and I was amongst them. But having fought the Fed, been wrong, then they had the last FOMC meeting where basically they all said, sod it, it's higher for longer. Now, my view on that was, okay, everyone is forecasting higher for longer. I'm still of the view that, they can't afford higher for longer because of what's going on with the budget and, the economy and all of this stuff. And, the risks are just far too great. So if you think that they are higher for longer, then I'm in the camp of they're more likely to reduce interest rates, earlier than is expected. And you can actually see that in a way. The yield on the 2-year just hasn't moved. Really, it hasn't moved. In Germany, it hasn't moved. In US, it hasn't moved. In the UK, it hasn't moved. It's not about the central bank interest rate rises now. Now it's all about what should the long end yield be. And that's the point where they've all been wrong about the recession. That's why they inverted the curve. Now they've said, okay, so we've got a bit of growth, so it should be, flatter. And in my view, if you do believe in a higher for longer, then you should go back to more inversion. And if you think that the yields are going to go higher, then for sure the central banks will be forced, in my view, to either yield curve control, or the Treasury themselves will shift all of their issuance into the short end of the market. And by doing so, that's another, they've been doing that anyway. That's a kind of a yield curve control, because, if you starve the long end with issuance, then yields in the long end won't gap up in any way like they have gapped up recently. So you may well see yields peak. And I actually think long end yields have at least peaked for a short period of time. I've still got no idea where they end up long term, but I still favor the trade to be long in the 10-year as a trade and not as an investment. This is really not for 5-year holding kind of stuff. This is for a 6 months trade.
You're in good company. Bill Ackman was in the news last week or the week before even that he dissolved his short on the long end in the market. He claimed political reasons for it. It's not the time to be short in this risky environment. The long end. If I look at this chart again, obviously it's the Fed funds rate. It could be that the forecast at this time actually get the short end of the curve right, but I'm being now devil's advocate here against my own position. But the market could still be completely screwed up because 10-year, the long end will keep rising because simply we do not have buyers anymore in the market. So we'll see another steepener in there, which will completely destroy the economy. And when I say we don't see buyers in here, it's another scary chart I had here, and I put the headline in, let's call the Chinese. I remember that line when Bear Stearns was in trouble, when Lehman was in trouble. And it simply shows the accumulated from Bloomberg Chinese investors offloading US bonds, agency bonds, corporate bonds, and stocks quite on a large scale till till the beginning of 23, even a little bit earlier. Why does it remind me of the Bear Stearns 2008 debacle? I remember how they were trying to calm down employees and was always like, yeah, we asked the Chinese will come in as a co-investor and they will save the day. Yeah, but the Chinese are not stupid. Yeah? They're buying value. And the question is, if they are selling their holdings in government bonds, in corporate bonds, in other things, what are they doing with the money, Nick?
Yeah, that's a really good question because, about a month ago, you saw the gold premium sort of at its sort of all-time high in China. So if you wanted to buy sort of physical gold to spot gold, the premium was at an all-time high. And you normally see this premium rise when there's concern about the currency. So people are either trying to protect themselves for a currency devaluation, or if they're worried about actually just a falling currency. There may well be currency controls in China, but people still manage to get their money out. So my guess is, what are the two things that are going up right now? You've shown the stock market, the US stock market, which was the go-to place for most international investors when they're a bit worried. They used to go to the US stock market. Are they going to the Treasury market? Well, Bill Ackman may have covered his short, and we might think there's a good trade to be had here. But I don't see a rally in Treasuries with, all of this sort of flight to safety stuff. The flight to safety is gold and is Bitcoin. And those are the two things that I've been saying for this is now the 26th 6 months view. The places to be, your core holdings should have those things that will protect you. And I think, the Chinese have figured it out as well, that the Western governments and maybe in China themselves have to print and pump money into the system. And that's a debasement. Now, China versus US dollar versus euro versus sterling, all trades in a bit of a sort of a narrow band. But the value of your wealth, Chinese yuan and US dollar and sterling and euros, is going to fall, in my view, versus, hard assets, strong assets. So whatever those strong assets are, and the things that we all know today are gold and perhaps silver, and in the recent years, crypto has been also an alternative. And I think that's That's basically what's been going on. And you can see that in price action. So this is where money goes. And also where you see money is going right now is in emerging markets, and emerging market stock markets doing well. And obviously they're doing well because the commodities are doing well. And that's a kind of a flight to safety as well.
It's interesting. You mentioned two of the three assets, actually, which each government with a stroke of a feather can prohibit individual investors to hold: gold and Bitcoins. Yeah?
Absolutely.
That's because the more I think about this picture here, I read this line several times now by quite clever guys who said, well, if you don't want to buy treasuries anymore to protect yourself against the uncertainties of the future, and that we had a long conversation about that on air before, with basically kicking the Russians out of the SWIFT system. Yeah, why would you actually get your money into US treasuries when they simply say, no, I'm not going to pay you? Absolutely. That's it. Yeah? The Chinese have seen that. Everybody else outside of the world sees that. So yes, Bitcoin and gold. I like both of these assets. Well, obviously I don't know shit about Bitcoin, but I like gold. And if you see how gold is trading at the moment, I said that before on the channel. Yes, it's amazing. It should be far lower at these interest rates, but it isn't. Yeah. So there might be a breakout on the cards, but well, the government's done it under Roosevelt, simply saying, you know what, we are in trouble. Well, you are not allowed to hold gold, and only until Nixon opened up that window again, individual investors were allowed to own gold, even though the United States was still dishing out gold against dollars until 72. So
but the difference is the size of the gold market is about 10, 11, 12 trillion. I think that's the kind of number we're talking about. And the size of the crypto market is like $500 billion. So those two markets together are a drop in the bucket of, you know, it's like an eye of a needle, and everyone is going to sort of go through this eye of the needle into gold and crypto. Ain't going to happen. And it's not so easy to do that. So, you know, gold and crypto still provide solutions for governments. And you know, I go back to a piece of research that over the years, Luke Groman has been sort of harping on about. And, you know, we're getting closer to the time where gold may well be a solution for the US government to revalue its gold holdings and to say, well, you know what? You know, yes, we've got an awful load of debt. Over the next years, we're going to be paying an incredible amount of interest. So why don't we just revalue gold to $20,000 an ounce, and we make our treasuries gold backed, and then interest rates will fall to 0.5% or something incredible. Their debt is therefore eliminated, and Bob's your uncle. Solution to the problem, you can move forward. And so, you know, before they destroy the gold market, they might want to rethink. And I think this is not a stupid idea. I think a few years ago, it was a stretch to think about that. But going forward, it may well be still a solution for governments who are in trouble. Let's face it.
Lynn Alden made a very good point in her new book, which is a fantastic read. So big plug on air. And I never thought about it that way. She was going into, well, the whole development of the world. Actually, since we have fiat currencies, war is more likely and more possible than it has ever been. Because in the olden days, you had to pay as you go. You wanted to have a war, you had to slap taxes on people and tell them the costs that were involved. The moment we invented money and removed it from any gold standard in any way, shape, or form, it was able to have wars and let the future pay for it. People weren't affected by it all. We saw that with George Bush. He had tax reductions when they went to war with Iraq. Not what usually happens in a war when you pick up when you increase the taxes. I'm a big fan of Milton Friedman, obviously, and he hated gold as a gold standard because he said, well, it destroys growth. You only get it out of the ground by a rate of 1.5–2% a year at best, and that's then the limit to the growth you have. But if you see it under social aspects, I thought, yeah, that's actually a point. If people would know war is costly, maybe they would tell their politicians, don't go to war. I don't want to pay for that rubbish.
Well, you know what, Milton Friedman, I am a big fan. I actually sort of follow his all of the things that he's been teaching everybody, and he's not been wrong about anything, in my view. But the notion of, you can only get 2% and 2% growth, and that's not enough. Well, I mean, at the moment, what is the growth rate for the economy? It's about 2%. That's what they're targeting, the 2% above inflation. It's now, I think, 1.8 if you look at the...
Not in the United States, Nick. We talked about that. We'll come to that later.
We're going to come to that, I know, but we're talking about the long-term path of growth as opposed to these crazy fluctuations, because there's still a lot of money in the system. But, just one last point on war and the comments that Lynn Alden made. I haven't read her book yet. Is that I'm also sort of in this foundation for the study of cycles. And last week they were speaking about, a lot of people think this is witchcraft, but this is that time of year for witchcraft. So solar cycles, and solar cycles combine have a very, very strong correlation with the buildup of wars. And solar cycles are every 11 years. And the peak in the solar cycle that we're in right now is around 2025. So therefore, there is always a buildup of sort of war talk as you reach these peaks. So, there is something to that at the moment. It's in the air, right? It's in your blood. It's the water that drives you, whatever it is. So this is also cyclical.
There is even, I read into that as well, there is even economic, it's not just esoteric, it's also a relationship. The world gets hotter. That's not good for harvests in parts of the world. So you have an undersupply of food. What is usually the cause of war? If one nation doesn't have what it needs and wants to get it by other means from somebody else.
Absolutely. It's not, in my view, it's nothing to do with fiat. It's something to do with, have you got the stuff you need? And, when I look at countries like Germany, they haven't got anything. They got, know-how in Germany, but they don't have energy. They don't have food. And,
well, thank God we also don't have a functioning army anymore. So everybody can sleep well on the continent. Yeah. Who was it who said that? Margaret Thatcher again? When you won the World Cup against us, or when we won the World Cup against England, and she said, well, yeah, they might have won the World Cup, but at least twice a century we beat them in their favorite game. So she got a point there. Bless her heart. Anyway, let's go to a more gloomy picture again, because we are still in the line of scary show. Today, tightening lending standards. That's from the Philly Fred website I came across, and it's an interesting point. The lending standards large banks have for medium and larger companies are tightening. And we see that like in 2020, and we don't have a recession yet. And we see it at levels of 2008, and we still don't have a recession yet. And we come to the economic numbers that came out last week in a moment. So keep this chart in mind. Then charts I showed already during, the course of our now, you said 26 shows we had already, Nick?
This is 26.
Yep.
We are 6 months.
So we have here the bankruptcy filings by year. Then we also have what I showed last week, non-revolving consumer credit on a monthly change basis. So the consumer obviously getting pinched as well. And then we came to this chart, and I had to put that on again. It's Apple market capitalization versus the Russell 2000. And what I found interesting, again, as I'm old as Nick is, we talked about that in the pre-show. The younger ones amongst you might not remember that. At the peak of when Japan was, the apple of the eye, the biggest economy ever, couldn't fail, could do nothing wrong. The real estate the Japanese emperor's palace was built on in Tokyo was valued as much as all properties in California combined. And at the time, Nick, you said it earlier, what was the trader's answer for that?
Yeah, that was, go and sell the building and go and buy California. I mean, it's a great trade. Or when you get situations like this, and when you showed me this chart, what did I say a few weeks ago? That there was, if the price of a stock, 3 trillion it was at the time, is worth more than the entire small caps. If I was, Tim Cook, I would simply be saying, okay, how am I going to grow? I'm not going to now make a red phone this year instead of a green phone. I'm not going to sell some expensive glasses. Why don't I look to grow, not organically, but to look at companies which are, developing technologies that would be useful, and basically sell, do an M&A. Sell my shares at extortionate level and go and buy these companies which are developing these new technologies. And I would say, I'm sure in 10 years' time, when we look back at this chart, that would be a sensible trade.
And that's the point. Actually, yes, every trader would have given the answer, well, sell the bloody Emperor's Palace and buy the whole of California. The only problem with that was you couldn't do it, right? And that's the point we see here. You're absolutely right in your analysis. I agree with that completely, to say, yeah, well, let's sell my Apple shares and buy innovation, small companies, go into the small cap sector and make a killing out of it. Again, I look at this chart and say, if this chart breaks, it still has a 25% weight in the tech indices. It's going to be a bloody nightmare if this breaks. I'm not saying it's going to do that. And we had this point, we touched it earlier.
Yeah.
You can't hide in treasuries anymore, and you only have a certain amount of exposure to cryptos and gold. Maybe megacorps are the place to hide your money. Yeah? Even in Venezuela, you would go into megacorps because inflation is not your problem with that.
That's right, because as people have been, around the world, been taking their money out of, Europe and putting it into America because of what's going on in Europe. They've been taken out of China and perhaps putting it into America as a great place to invest because they're worried about sort of the deflation that they have all of there. And this flow of money goes into ETFs, and the ETFs are all market cap weighted. And it just goes into Apple, it goes into Microsoft, it goes into Tesla, it goes into all of these FANG stocks, and that's why they outperform. But they do make money. So this is not just the fact that pure flow of funds. If you actually look, these companies, Apple and the like, they all make money, and that's something that can't be said of many European companies. So, for now, that trade might look good on paper, but my signals still don't say do it. But I'm sure over a long period of time, that is a sort of a reasonable bet to make.
Yeah,
I wouldn't want to own Apple. Sorry, at 3 trillion, whatever, with a red phone, and I just don't see any more where it could go.
Well, I will have to wait for the headset coming out in January, if that is actually, they're watering it down already. Because
Japanese have already got it. I think Seiko have headsets, these goggles. And by the way, I know we're just on, whilst we're on Tokyo, I've got to say this. And we talked about cars earlier. Toyota are going the other way. They're focusing on hydrogen. Well done, guys. And actually, they're looking at some solid state solution for batteries. These guys are basically saying to the rest of the car industry, you're wrong. And, good luck. And as you know, I'm a fan of, all things Japanese at the moment. I think I'd love to see how Toyota look versus some of these other car companies.
Yeah, I agree with you. That's one of the headlines you read at the moment as well. USA is not the next Japan. It's maybe the next Argentina. But we're not going into Argentina today. That would take too long. A couple of more slides I only go quickly through because I want to come, you've seen that last week, to the point, going into economic data. This is the banks we showed last week. Doesn't look too enticing. Then we have home prices collapsing, where we discussed whether, maybe we've seen the bottom now or we haven't. And then data, yay, we're awesome. I've asked Nic earlier, Nic, look at this, look at these economic numbers coming out of the US. I'm one of the guys, I showed you a lot of doom and gloom charts today, and my perpetual forecast of the impending recession. Well, obviously I gave it a little bit on the time scale, but I'm clearly behind what I've already expected. And then we get numbers. Advanced GDP 4.9%, 4.5 expected. So everything is hunky-dory, right?
So I've got two comments to make. Yes, all of those charts suppliers of yours who, you see on LinkedIn or Twitter or whatever, that have been predicting the end of the world, who got it totally wrong. Give you inverted yield curves as excuses for, they're all totally mistaken, and they haven't really understood that actually we are in a very special time because of how the government solves the COVID problem. And therefore, we're not going to go back to normal interpretation, I think, for a couple of years still. So that's the first point I want to make. The second point I want to make is that, it's all very well. I love the number 4.9% real GDP. So nominal is about 8 point something. Don't ask me what it. Over the year, you can expect something like real GDP of around 2.5%. Let's just say. And let's just say nominal GDP, I don't know what the number is. Let's say it's 5%. What is the deficit from the government this year? It is far in excess of that. And what it does show you that without government deficits, and you asked me in one of our episodes before, why haven't we got a recession? And I said, that's because the government are borrowing money like crazy. They are running deficits, and they are compensating for the fact that the economy is not growing. No other country on the planet has got this ability to run forever deficits, except the Americans. And they are taking full advantage of it. And I don't blame them at all for this thing. But if you look at what happened in the UK. I mean, this is not a small country. They said, oh, we'd like to do a little bit of unfunded spending. Destroyed, guilt's destroyed. The Americans have unfunded deficits for the next 40 years, 50 years. And nobody has nobody could touch this market, and rightly so. So they have the ability to do this. That's why it's an exceptional situation, and that's why everyone keeps running to the States. But they're running out of, this sort of, this pull. And part of it is to do with the foreign policy. I think, people are not happy with foreign policy. Part of it is to do with the fact that the BRICS have got their act together, and they're going down their own path for growth going forward. And so the Americans have to solve this problem. So forward-looking, if you can't create growth by just having forever deficits, how do you create growth? And I think the Americans haven't figured that one out yet. But at the moment, they've got probably a good few years where they can continue to do this. And whilst they're running these deficits, you're going to struggle to see recessions, right? And, something dramatic has to happen for the economy to sort of start to show negative prints. And that's going to be the thing to watch. What are the drivers for that? At the moment, I don't see it.
Dear listener, there you have the explanation. I full-heartedly agree with that. The point is, when we talk about nominal figures, you just throw the 8% in, yeah? Obviously, we've taken inflation out at the numbers we see here. But it makes you think, is the United States the new China? Can you believe all that stuff that's coming out there?
Interesting, because when you get growth numbers like this, that is the level where you say, what is the target 10-year yield? So you'd say part of the 10-year yield is short rate, part of the 10-year yield is the growth rate, plus inflation. So that's how you get the 10-year yield calculation. And if you look at the yield on the US debt, well, I mean, Cyprus has lower than the US. Some emerging markets have lower than the US. So what is the situation with US debt right now? It's a big question mark, I must say.
Isn't it the old saying, our currency, your problem?
Yeah, I mean, that's the thing. It's soon to be their problem as well, because people aren't supporting it.
Yeah, well, meanwhile, the leading indicator I showed last week tells us it all sucks, the big one. Yeah. So, but we found out now, obviously, as long as you can print money, you will be fine. I've already showed this chart before. Obviously, I want to get right at the end a nice, another doomy and gloomy one in. So, yes, Bianco research said 10% correction since the July highs, and nobody seems to think it's a big thing. They will start thinking it's when they start thinking it's a big thing, then we might be coming closer to the bottom edge of it all, and I looked into the 2008 chart and the 1987 chart. 1987 didn't fit quite nicely, but 2008, I put a similarity in here where I think this is a scenario. People like, well, we both like Peter Schiff, yeah, and he's doom and gloom for the last 20 years, if I get that correctly.
I won't say I like him, but I think I understand him.
And he said his guys at Schiff Gold are working overtime this weekend because it's still October, so there's time for a crash on Monday and Tuesday, which I find interesting. So obviously we're always smiling a little bit about Peter's forecasts. The interesting point is his economic analysis is not bad, just the markets don't do what they are supposed to do. Yeah, gold should be trading far higher, especially with his inflation call he made in the past. But everything that he said on the economic side would happen did happen, but the markets are reacting in a different way. And then next week, and then we might close this magnificent show of doom and gloom for the day. So the Fed, what's the Fed going to do? Nick, last time I said the Fed should raise interest rates by 25 basis points and then have it. That's it. And then they've built up ammunition that they can lower it. What are we having this week coming?
Nothing.
Yeah, this time I totally agree with you. The bond market took care of that. There's no reason to further check up the interest rates. So we will stay, if nothing happens, 1-0 for you in our forecasts.
Yes, indeed.
So what's the last?
How's the hedge going?
Oh, the hedge is going magnificently. We bought it at $20. Yeah, that was the 3,900 put on November the 30th and 3,895. We sold short against it. So a spread where you could make $5. We paid 20 cents for it. It's now trading at 130 in 2 weeks.
So 5 times your money.
It doesn't mean I want to cash it in now and run victory laps. It was a tail hedge. It's in the portfolio for exactly these purposes. When we put it up, it was a 1 to 20 you could make out of it. That's why we leave it in there. I'm still pretty sure we might lose the original $20 we put into this hedge, but it's nice to have it on. And if you don't have a portfolio which you like to hedge, well, yeah, fine, cash it in, be happy, be lucky with it. But it's not the original purpose of it all. What could save our lifeline if Peter Schiff is right? This isn't the last chart. It's a season to be jolly. The seasonalities are found, and we are on the red line. Second year, new Democratic president. So we'll see a very weak October, end of October. That's what we are experiencing at the moment, with a light, well, let's call it short covering on Monday or Tuesday, probably on Tuesday. If the market behaves like the seasonalities will show, then we see a boring November, sideways trending, and then we have to make sure that Mr. Deamon can sell his shares in January at a nice level, and that would forecast the year-end rally everybody was expecting, already talking about. At the moment, it doesn't look like it. The hedge, just to go back to that, performed quite nicely at the moment because we have this velocity suddenly to the downside. So the gammas are now starting kicking in. We're getting closer and closer and closer. November the 30th is the deadline, so it has a month to run. That's why you suddenly see the dynamic in this tail hedge. And as I just repeating myself, see it as a tail hedge. It's nothing fancy put on. And then eventually, when we see how markets work out, we'll have another look in the business cycle, our quad model playbook. And I'm still waiting for this nasty little quadrant, the slowdown or the recession hitting it. At the moment, the data is just showing us, hey, 8% nominal growth rate in the United States. It's awesome. What doesn't work in the VIX has started to increase, and the MOVE volatility index for bonds is at elevated levels, relatively stable. However, we have the bear steepener as forecasted in the expansion sector in here. So let's see what it all brings. And let me switch this off now. And I actually made it through a whole show with a plastic wig on. Isn't that marvelous?
Well done.
So let's see what will happen. Obviously, Thor's not wearing glasses. I do. I have to. Nick, any famous last words before we hit the road and see you next Sunday again?
No, I just think that Chris Hemsworth is going to start sending you lawsuits next week for for ruining his look.
Okay, I give you the real look to switch it off. So, you know it. Halloween is a big thing in our house, and I have to play along. In the olden days, before this costume came out, I was always wearing the costume as a devil, as a banker somehow. I was already put in this spot, so I prefer my Fat Thor model. It's fun. Nic, thank you very much. I think it was an awesome talk we had today again. To all our viewers, thank you for watching us. And as we showed you today, doom and gloom, take it with a twink of the eye. Have a lovely weekend and a very good week in front of you. Bye-bye.
Bye-bye.